How many weeks of inflows have we had? 18?
Yeah, it's at least 18. On a year-to-date basis, it's approaching record inflows into open-end municipal bond mutual funds, and it's a great thing. I think investors generally are feeling pretty comfortable with the asset class.
So this looks really, really tight relative to treasuries at the moment. You still think there's value further down the curve. Why?
Yeah, we really do. I think that, when you think about valuations in the municipal market, there are really two elements that you're constantly concerned about. One is the muni to treasury relationship, and that's driven a lot by technicals, just overall supply and demand. Another aspect of it is credit fundamentals, and in general, the municipal market has enjoyed pretty strong credit fundamentals. We're coming off of the back of 10 years of major credit stories in the municipal market that are all sort of being lifted one by one off of the back of the municipal market, such as local jurisdictions in California going back 10 years ago, things like Stockton, Vallejo, San Bernardino, fast forwarding to Detroit, fast forwarding to Puerto Rico. These are major stories that have weighed down on the municipal market that are largely being lifted, and I think that's giving investors some confidence.
In this environment right now, are you finding this sector, this asset class is trading a little bit more like treasuries and less like credit? Is that what's happening?
It's a great question, and the answer is not really. If you look at pre-2008, municipals were largely a high-grade market. It was largely commoditized by virtue of AAA ratings put on there by insurance wraps that largely covered the investment-grade world of munis. Post-2008, the insurance companies lost their AAA status, and that set into motion a recalibration of the municipal market, trying to figure out the right credit spreads within the investment-grade space, which I think is probably the most interesting result in the post-2008 market is the value that we're able to find within the investment-grade space of municipals.
So let's talk about some of the inefficiencies as you see them at the moment. A lot of people are worried at the state level as to what is going to happen with various taxes and people moving away from high-tax states to lower-tax states. Is that starting to show up yet in price?
It's very interesting. Not really. And the whole topic of migration from high-tax states to low or no-income tax states is something we're watching very closely. It hasn't yet manifested itself in the numbers. But that's something that we'll take a look at, very closely over the next couple of years.
You expect it to show up in the next couple of years?
We actually do. If you take the example of California, California has had, you can read as many articles about the net in-migration of millionaires post Proposition 30, which was 2012, a very large state income tax increase. And there's actually been net in-migration of millionaires into California since that time frame. But a lot of that is probably masked by the overall tech boom that's been going on in California for the last 5 or 6 years. So when things normalize at the economy level in California, it's very possible that migration could be a big factor.
Well, to wrap things up by talking to you about structure, the kind of bonds that I should be owning right now, whether it's floating rate or fixed coupon. How are you guys at Goldman thinking about that at the moment? Floating rate really out of fashion ever since the Federal Reserve backed away. It's had a tough time, particularly in high yield, the leveraged loan space. Yeah. How does that work out in munis right now?
Yeah, it's a very interesting question. We're always contemplating the differences between coupon bonds, zero coupon bonds, floating rate notes, all of which are available in the municipal market. And it's a very dynamic relationship between those three basic categories of municipal bonds. And the trick is to diversify your portfolio to take advantage of when they're attractive. The spreads are always changing between those three different sort of subclasses of municipals.
So Ben, got to talk about the trade story just to wrap things up. What are you saying to clients in the last week or so off the back of all of this?
I think the most direct impact that we in the municipal market would be concerned about would be port cities,
yeah.
Areas with large manufacturing. On the whole, we don't think a tariff and a trade war will be that significant in the municipal market, but those are the things that we'll really be looking closely at.